When markets crash and fear spreads everywhere, most people panic. They sell investments, stop investing altogether, and focus only on avoiding further losses. But smart investors often react very differently during these moments. Instead of seeing fear as a reason to run away, they see it as a time when valuable assets may finally become available at lower prices. History has shown that some of the biggest long-term opportunities appear during periods of uncertainty, when emotions drive prices down more than fundamentals. Today we will talk about why smart investors buy during fear. So before we get started, make sure to hit that like button. Also subscribe to my channel. 10. Most people invest emotionally without realizing it. When markets are rising, investing feels easy. Prices go up, confidence grows, financial news sounds optimistic, and people begin believing wealth creation is simple. During these periods, many investors feel comfortable taking risks because optimism spreads everywhere. But the moment markets fall, emotions change completely. Fear replaces confidence, headlines become negative, and investors begin panicking about losing money. This emotional shift causes many people to sell investments precisely when prices become cheaper. Smart investors understand this psychological pattern deeply. 9. Fear often pushes prices below real value. One of the biggest reasons smart investors buy during fear is because panic can disconnect prices from long-term reality. During market crashes or economic uncertainty, investors often sell aggressively simply because they are afraid, not because the underlying assets suddenly became worthless. Strong businesses, productive assets, and valuable companies may decline heavily in price, even if their long-term potential remains intact. Smart investors recognize this difference. They understand that temporary fear can create discounts on assets likely to recover later. 8. Human psychology repeats every market cycle. Financial history shows the same emotional cycle repeating again and again. During booms, greed dominates and people become overly optimistic. During crashes, fear dominates and people become overly pessimistic. Smart investors understand that markets constantly swing between emotional extremes because human behavior rarely changes. Fear causes people to assume bad conditions will last forever, just like greed causes people to believe markets will rise endlessly during bubbles. Experienced investors avoid both emotional extremes. 7. The best opportunities usually feel uncomfortable. One reason buying during fear is difficult is because real opportunities rarely feel emotionally safe in the moment. When markets crash, uncertainty increases everywhere. News becomes negative, predictions turn pessimistic, and investors fear further losses. Buying during these periods feels uncomfortable because emotionally it appears risky. But smart investors understand something important. If an opportunity feels completely comfortable, prices often already reflect widespread optimism. The greatest long-term investments frequently happen during periods when public confidence remains weak. 6. Long-term investors think differently about time. Ordinary investors often focus heavily on short-term market movements. A few weeks of volatility may feel extremely important emotionally. Smart investors think differently because they focus on longer time horizons. They ask whether strong businesses, industries, or assets are likely to remain valuable years into the future, rather than worrying only about temporary price fluctuations. This long-term perspective changes how fear is interpreted. Market declines become temporary phases rather than permanent disasters. Investors focused on decades instead of days are often far more willing to buy during uncertainty, because they believe recovery eventually becomes likely over longer periods. 5. Fear creates liquidity problems for emotional investors. During market panic, many investors sell not because they want to, but because fear overwhelms them psychologically. Others may face financial pressure forcing them to liquidate investments quickly. This sudden selling pressure can drive prices down rapidly, even when underlying fundamentals remain relatively stable. Smart investors understand this dynamic clearly. They know panic selling often creates temporary inefficiencies, where assets trade below their long-term value because emotional behavior dominates rational analysis. Investors prepared with cash and patience can sometimes take advantage of these moments, while others focus only on escaping uncertainty. 4. Wealth is often built during crises, not booms. One pattern repeated throughout financial history is that enormous wealth is frequently built during difficult periods rather than optimistic ones. Investors who bought quality assets during recessions, crashes, banking crises, or periods of fear often benefited significantly once markets eventually recovered. During booms, optimism already pushes prices higher. But during crises, emotional selling sometimes creates opportunities unavailable during stable periods. Smart investors understand this deeply. They know downturns may create temporary pain, but they also create entry points capable of generating strong long-term returns later. 3. Fear changes public narratives dramatically. During economic fear, public narratives become extremely negative. People begin believing markets may never recover, industries may disappear permanently, or economic systems may collapse entirely. Smart investors recognize that fear distorts perception. Negative headlines become emotionally powerful because human beings naturally focus more heavily on threats during uncertainty. 2. Smart investors prepare before fear arrives. Buying during fear sounds easy in theory, but becomes emotionally difficult in practice. This is why disciplined investors prepare mentally and financially before downturns happen. They maintain long-term strategies, avoid excessive debt, hold liquidity, and expect volatility as part of investing itself. Preparation matters because fear creates opportunities only for investors capable of surviving uncertainty emotionally and financially. 1. The real reasons smart investors buy during fear. The deeper truth about investing during fear is that markets are driven not only by economics, but by psychology. Fear causes people to focus heavily on short-term danger, while ignoring long-term recovery potential. Because the truth is simple, emotional selling often pushes valuable assets below their true long-term worth, creating opportunities for disciplined investors capable of thinking independently during uncertainty. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.